So that takes away from some of the very positive statistics. And if you looked at the ISM service report this week, employment in that report was surprisingly weak, just like in the manufacturing part of that report. So again, conflicting indicators.
Cathie Wood, founder and CEO of ARK Invest, is very worried about the U.S. economy. There are still a lot of heated discussions going on about the Federal Reserve's monetary policy and what it means for the economy and the financial markets going forward. A lot of well-known experts, such as economist and former Treasury Secretary Larry Summers, have spoken out about the Fed's decision to cut its policy rate by 50 basis points instead of the expected 25 basis points. According to Summers, the better-than-expected September jobs report was caused by the Fed's announcement. He also says that things could quickly get out of hand if the right steps aren't taken. However, W is sure that the U.S. economy is cooling quickly and more rate than Summers and others are predicting. Cuts might be needed right away to keep the economy from going into a nasty fall that will put the whole economy into a recession.
It was much stronger than expected, but as usual, there were puts and takes. I would say on balance, stronger than expected. We had non-farm payrolls at, I think, 254. They were up 254,000. The expectation was about 150,000, and the past 2 months were revised up by 72,000. So upward revisions are a good thing. Now, we had been seeing downward revisions for quite a long time. So this is a departure, and we must take note. I will also say that the indicators that were strong were healthcare, education, government primarily. If you looked at cyclical indicators, exceedingly weak, still exceedingly weak. So that's non-farm payroll. The unemployment rate, so the headline number, actually ticked down from 4.2% to 4.1%. Many thought it would tick up. It did not. And then the average hourly earnings were a bit stronger as well, 0.4% month to month. Expectation was 0.3. So average hourly earnings are going up 4% on average per year. Now, productivity, it seems, is in the 2.5% to 3% range. So what that means is if average hourly earnings are at 4% and productivity 2.5% to 3%, then the underlying inflation rate is in the 1% to 2% range, probably. So that's good. It's good that wages are going up as productivity goes up. Corporations are sharing some of the wealth. On the negative side of the unemployment rate, the manufacturing was down, temporary help was down. Temporary help's a leading indicator, but it's been coming down for a very long time, so it hasn't been much of a leading indicator. Hours worked were down about 0.3%. So that takes away from some of the very positive statistics. And if you looked at the ISM service report this week, employment in that report was surprisingly weak, just like in the manufacturing part of that report. So again, conflicting indicators. In terms of the week-to-week initial claims, those have surprised on the low side of expectations. This week, JOLTS, so job openings, those surprised on the high side of expectations after coming down fairly dramatically. So that was interesting. And I guess the only other variable on the labor side was the Challenger layoff survey. That shot up 53% on a year-over-year basis. So we know there are layoffs. We read them in the newspapers, and they are up 53% on a year-over-year basis. So in terms of, I'm now going to separate just in the last month, just the balancing act that's going on here in in the world of economic statistics.
Cathie also talked about the September jobs report that was just released. The U.S. Labor Department says that 254,000 new jobs were created last month, and the jobless rate fell to 4.1%. It was better than investors' predictions of 140,000 jobs and an unemployment rate of 4.2%. Experts think this is a big boost for the job market, which has been showing signs of weakening. At the same time, Summers and others are complaining about how strong the job market is. Cathie says that the report still gives a lot of confusing information and that there are still signs that the economy is weak in many areas. Cathie says that the manufacturing business is the thing that worries her the most. She said that the sector should be showing more signs of growth by now if we want to avoid a recession in 2025. Here are some short clips from videos.
So, household net worth, the change in net worth, that was up very strongly. The stock market has been up. Home prices have been up. Those are the two biggest indicators. Now, if you look at both of those in the stock market, market concentrated towards very few names, that's not a great indicator. We prefer to have it broadening out. And in the housing market, while pricing is up, the actual units sold, units started, have collapsed and have not come back. In fact, I look at some of these indicators, and I started in the business when I was in college in the late 70s, and some of these housing indicators, the home sales, existing home sales, new home sales, they are lower now than they were when I started in the business. That's crazy. The population is so much larger. It's quite shocking. The number of people trapped in their homes by very low interest rates. They can't move because if they do and take on another mortgage, their mortgage rates will go up twofold or threefold, maybe even fourfold. And so that's definitely lowered the velocity of housing. And that's not so great. Also positive, I mentioned University of Michigan survey. Here you can see it ticked up. Again, I think inflation coming down is very important there. We saw retail sales in the month of August, reported in September. They were up very slightly, in fact, probably down in real terms, but they did not fall back much after a very strong reading, the 1.1% the previous month. So we have to put that in the strong camp. Mortgage applications in the housing realm have been moving up quite nicely. So that's a positive for housing. Industrial production was up strongly in this last month. And that's after a significant decline. But the revisions there are now starting on the upside. And then finally, the ISM for the service sector, that was much stronger than expected. Okay, so those are the strong. Now, on the weak side, leading indicators are still falling. They've been falling for, I think, 2 years. Leading indicators, when I started in the business, if they were down 3 months in a row, then the probability of recession was very high. So there is something in the underlying economy that is not well for the leading indicators to continue down. If we look at the personal income and saving, we saw something that, again, I was shocked to see this, the revision so significant that the saving rate went from 2.9%, that's where we thought it was the last time we showed you charts, it's now 5%. I think we have this on the next chart. So it's now 5%. Now we were operating under the assumption that the saving rate was very low, and it's low by historical standards, but it's not as low as we thought it was. And one of the reasons is transfer payments. So government subsidies have been much higher than expected, and dividends. Those were the two primary indicators to revise the saving rate up. When employment starts weakening, which it had been, and may continue to be weak, we don't know, maybe this is an aberration in this last month.
In a study released on Monday, JP Morgan analysts voiced optimism for the cryptocurrency industry, pointing to the historical pattern of robust Bitcoin returns in October. Although past performance does not guarantee future performance, we believe that October's popularity may affect behavior and lead to a successful month for Bitcoin this October. The analysts pointed to a number of significant events, such as the Fed's recent announcement of a rate decrease in expectations, that would contribute to a successful month for the cryptocurrency market. The study also mentioned our possible impact. The spot Bitcoin ETF offered by BlackRock is authorized for use in options trading. According to the experts, investors now have a more active way to interact with the ETF and influence the underlying asset's liquidity, which might enhance market structure and liquidity outside of Bitcoin and spot Bitcoin ETFs. Analysts at JP Morgan also anticipate that, as the cryptocurrency ecosystem grows more susceptible to external influences, Ethereum's Spectra upgrade will eventually change its value and cost. The analysts stated that, in order to produce secular growth for the ecosystem, they are waiting for the next big catalyst for development and improved retail involvement. Do you see any indications? Thank you for watching this video.